The second type of company is a public company, and it just has Ltd. It doesn't have Pty Ltd, and that doesn't mean that means proprietary is not limited. What does that mean? Well, we've got two types of companies over here. In the private sector, we've got private companies, proprietary limited to 50, maximum of 50 shareholders. Public companies here, though, it's not limited at all. So the definition is an incorporated business or a corporation, which is a separate legal entity to its owners or shareholders, and it is listed on the Australian Securities Exchange. So the number of owners is not, there's no maximum basically. So the number of shareholders can be unlimited. The shares are on the Australian Stock Exchange, and it is a separate legal entity to those owners. So BHP has over 500,000. Some companies have millions of different shareholders, no maximum whatsoever. So therefore, if you were just one of 500,000 shareholders at BHP, you don't work there every day. And that is why you appoint managers or the board of directors. You get them to run the business on your behalf. Basically, as a shareholder, you get to vote, and we did an earlier video about how companies run. You get to appoint at the annual general meeting who you want to be on the board of directors, and they manage it on your behalf. And the financial risk is shared based on your percentage ownership. It's likely if you own shares in a public company on the stock exchange, you only own, so a fraction of a percent of the company. So therefore you will only share in a fraction of a percent of the profits, which we call dividends. The best thing about it is it's got limited liability. If the company goes broke, you cannot lose your personal assets. So if you want to go and buy some shares on this stock exchange today, you're not going to lose your personal assets if the company goes broke. You're going to lose your investment, but you're not going to lose your house, your car, your iPhone, whatever. And perpetuity, it has perpetuity. That means that, every day millions of shares are sold in every business. So BHP can be, 10 million shares a day. We don't need to re-register a new version of BHP each time. BHP continues to exist. It's just who owns it changes. So pros and cons. Well, we're going to have a lot of the same ones we had with a private company. And they include these ones. The owners have got your limited liability. You can get more money just by issuing more shares, and potentially, you can source funds. So this was up to 50 owners for a private company, but for a public company, it's unlimited. So you actually get more than 50. You can have millions. You've got the perpetuity. So if the ownership changes, you don't need to create a new business, and you can hire the best directors and managers to run the business on your behalf as a shareholder. A couple of added advantages you get with a public company is you get a greater access to funds. So here we said 50 for private company, but here there's no limit. So we sort of take this one and expand it and say there's no limit on the maximum number of shareholders. And lastly, it's the best way you can buy and sell shares at the click of a button on the internet every day on the stock exchange. It's a really easy way to buy and sell shares. So that's a real positive of investing in a public company instead of a private one, is you don't need to find a private buyer for your shares. You just jump on the stock exchange, and when you want to buy them, you don't need to know someone who's selling them. You just jump on the stock exchange and you can find shares anytime. Disadvantages though, there's some big ones. Really complicated to establish. You're going to need to pay thousands, if not millions of dollars to lawyers and accountants to set all this up. You've got high government regulation. You've now got to publish all your financial information to the public, and also anything that's of a material nature or a material event. So anything could be a scandal. Someone stole some money at work. You've got to tell the stock market that, because it's important to the share price. And that's a really big burden for a public company, is to have to publish all these material events. Also, you've got little ownership control. Earlier video, we said if you bought some shares in Facebook, well, got some bad news. Mark Zuckerberg owns 400 million of the shares, and he controls 58% of the votes. What control do you really have in a public company? Not much. You're not really buying it for control. If you want control, you're going to pick a private company, a partnership, or a sole trader. And lastly, profit pressure. That's all the share market is. Pressure to increase the share price every day by maximizing profits, and that can create a lot of disunity within a business. And when we look at ethics and social responsibility, can lead to some unethical behaviors, and we'll look at some examples of that. And that's because if you own a business that you manage and run, you understand that profits are hard to achieve. But when you are a shareholder in a public company, you don't work there. You don't know anyone that works there. You just want big fat dividends every year and for the share price to go up. So all you care